Hello there, and welcome to iSectors' fourth quarter 2024 market review video. My name is John Koch, iSectors' Chief Investment Officer, and I am joined by the CEO of iSectors, Vern Sumnicht.
Thanks,
How you doing
John.
today, Vern?
Thanks, John. Good. You and your team have done a great job on this presentation and bring out some good research. And I think I'm just going to let you go ahead and present it. It's fantastic. So thank you.
Sure. Okay, that sounds good. Of course, chime in if you have anything to say, but otherwise we will go ahead. Today, we're going to do a quick recap of the stock market in 2024, and we'll compare its performance, its recent performance, with some other historical periods to see if any parallels can be drawn. And then we'll also cover how some of our models are allocated here in early 2025, given those recent strong returns of the market and the current economic environment. So 2024 was a very good year for the stock market. I'm not telling you anything you don't already know there. Every equity sector over the last year has been positive. Almost no matter what you invested in last year had good performance. But the most interesting part about that is that every sector had great returns, but this was all despite a wall of worry, so to speak, by many market participants. I mean, there are wars overseas, not just one, multiple wars in Ukraine and the Middle East. The interest rate environment has been unstable, to say the least. The Fed started cutting interest rates in September, and after bond yields had been dropping all summer in anticipation of the first Fed cut, after they cut, bond yields have only gone up since then in September, which was unexpected, to be sure. Going hand in hand with the volatile interest rate situation is that the trajectory of inflation has become even more uncertain. The Fed set a 2% year over year goal for the CPI, and inflation was heading in that direction. It was going down, but now we're around 3% year over year for the CPI, and we've hit a plateau. And there's not really much sign right now of inflation continuing lower. Potential tariffs from the new administration have kind of stoked fears that the price of goods are only going to increase. I mean, I don't know how many times I've heard someone mention the price of eggs lately, but that's another story. At the same time, the headline inflation number is stuck around 3%. Money supply growth has only increased over the last year. And increasing money supply usually coincides with an accelerating inflation 18 months or so later. So if we get the money supply continuing to increase and we're at a plateau on inflation, that inflation number could actually start to reaccelerate and go back up. So we have a market concerned about wars, high interest rates, and high inflation, but that hasn't really seemed to matter when it comes to the actual performance results, like I said. And that actually extends over the last 2 years. The last 2 years for the S&P 500 have both returned over 25%. In fact, this is the best 2-year period out of the last 25 years for the stock market. There has not been back-to-back years of 20% plus returns since the dot-com bubble in 1998 and 1999. In fact, in that period, we actually saw 5 straight years above 20% returns from 95 to 99. Of course, we all know what happened next. The dot-com bubble burst, and then stocks were negative for 3 years in a row following 1999. Interestingly, if then we try to look back and find the previous occurrence of back-to-back years of 20 plus returns for the S&P 500, that came in 1982 and 1983, as you can see here highlighted at the bottom of the chart. Following those 2 years, after 82 and 83, there was a stretch of 15 years where there was only one negative year out of those 15 going into the dot-com bubble that you can see at the top, where we had those 5 straight years above 20% leading into that bubble bursting in early 2000. So then what about this year? What about 2025? Are we in danger of a prolonged bear market like in the early 2000s? Or will the bull market continue like the run we saw for most of the 80s and 90s? Unfortunately, I can't answer that for you right now because I don't own a crystal ball, not one that works anyway. But what I can tell you is how we are positioned going into 2025 and what we think that means for the stock market this year. So our quantitative flagship strategies, the iSectors post-MPT allocations, have seen an interesting trend develop recently. They've favored 2 sectors above all else every single month when we rerun the model that powers these portfolios: gold bullion and technology. In fact, even when we test experimental settings within the model, we run random back tests, we try different things, the trend remains intact. We can change the risk settings, the historical look back period, the maximum allocation it allows for the different sectors we have. It still prefers gold and technology the most out of all the sectors we have in the investment universe for the post MPT models. This preference for gold and tech has worked out fairly well, as you can see on the chart here. Both have risen over 25%, similar to the broad market in 2024, with gold providing a sort of zig to technology zag, as you can see the blue and red lines crisscrossing throughout most of 2024 here. So why does this blend keep coming up? What's so great about it? What tech and gold together, what makes it special in our eyes and the eyes of our model? Well, they've worked very well together, like I showed. Technology, first of all, it pretty much represents the broad market within our sector-based model. It has the highest overlap, the highest correlation to the S&P 500, and it's also had the best 5 and 10-year returns of all the sectors within our model. As you can see on the chart on the right, the 5 and 10-year number for the tech sector has been stellar. And so the technology represents just broad market exposure, right? And then the gold half of this blend, there are other things in the model, but these two have been near the top. We have a maximum allocation to both within the post-MPT models. Technology sort of handles getting market exposure. Gold, on the other hand, it's done a good job working as a complement to technology as a diversifier. In our eyes, we see the model's insistence on these two asset classes being heavily weighted as a sign that diversification is needed in our current environment. There hasn't been much that has made sense over the last few years with regards to the market. Good news is bad news. Bad news is good news. Market is performing better than ever, even though it seems like the average American is doing worse than ever. Like all those problems I mentioned earlier that we discussed. So to us, to the model, gold represents the best way to hedge equity exposure in case the good times for the market don't last. The model prefers gold instead of bonds as a diversifier. It's important to point out. Right now, with both growth and moderate, post-MPT growth and moderate, we have the lowest allocation to bonds at over any point of the last 10 years between the two models. They have not only performed poorly, bonds have, but they're also not providing any diversification from equities right now in any way. The chart on the right illustrates that. The Bloomberg Aggregate Bond Index has maintained a correlation well above 0.5 since the start of 2023, even creeping above 0.75 in recent periods. And this is coming from an asset class that has had negative correlation historically. In recent periods, it's been a fairly high correlation. Gold, on the other hand, has maintained its same historical correlation to equities over this same time frame. It's remained below 0.5 for this whole period, and it's even dipped into negative territory in recent months. And if you want true diversification in a portfolio, you need assets with low correlation to each other, like gold and technology, for example. Otherwise, you'll get what happened in 2022 when the traditional 60-40 stock bond portfolio had its worst performing year of the last 100 years.
John, it seems like and as we discussed in our other video today, that we're putting out on fixed income, that the 60-40 stock bond model is broken, and it appears that a better model is a equity based on technology, and gold bullion model gives much better risk adjusted returns than we're going to see in a 60-40 stock bond model. Anyway, thanks. That was a good presentation.
Yeah, agreed. Essentially, our model, our post-MPT models have essentially substituted gold for bonds within a diversified portfolio. And
yeah, it's interesting.
It's worked. Gold has had stellar performance alongside low correlation, which is sort of the best of both worlds. And so it's been great. Besides those models,
we've had some financials, we've had percentages, single digit.
There are other
in the other equities, but obviously technology, for all reasons a lot of people understand. But even in a recession, it seems like people have now, even in a situation where there's fear of recession, people are more interested in owning technology because even in a recession, they feel apparently that technology will continue to produce some kind of returns in a recessionary period, where some of the other equity classes are kind of questionable, and certainly bonds, in this inflationary period, are simply not. They're just simply not keeping up, and people are, unfortunately, if you do a 60-40 stock bond, you're almost guaranteeing your clients that 40% of the portfolio is simply not going to keep up. So this is very interesting. Thank you.
Yes, absolutely. And we have shown here is our entire list of models that we offer. We have plenty of other alternative options, diversifying options that do not follow a traditional 60-40 allocation. So if you have questions about any of those or want to learn more about the models, our view of the market, give us a call.
Or if you
Here's our
need
contact
help,
information.
also
Sure.
if you need help with a particular client, our models are designed to be blended. And we use them for our clients in a way that is appropriate for the particular client. So we can blend portfolios for clients, giving you risk
You can
adjusted.
customize them. You can
Yeah.
customize these pretty nicely. They work. A lot of these work well as sleeve allocations, satellite allocations. So, yeah, you can
If
even
you
blend
want
them
some
with
more help with that, with
Mhm.
a particular client situation, give us a call and we can give some suggestions and do
Yep.
some research for you too. Take a look at the models, take a look at some blends for you, and give you some, input on how the historical, what that would have done for your clients historically. Um, have a discussion about the risk adjusted returns and your clients, particular feelings. Maybe they don't like gold for whatever reason. Maybe they don't like technology. What else can we do? There are things. So give us a
Mhm.
call. We'd be happy to help.
Yep. We love research. That is for sure. That's our bread and butter there. Investment research. So here's our contact information. And as you carefully inspect the disclosure page, I'd like to wish you all, happy, a good day here and have a good day. Bye.